Did you know the profits you earn from the stock market are taxed? Are you aware of strategies to legally reduce your capital gain tax liability? Have you heard about a method called tax loss harvesting, TLH? If not, don't worry. In this video, I'll guide you step by step through how tax loss harvesting works, its benefits, and everything else you need to know to reduce your taxes effectively. Tax loss harvesting. A complete guide to reducing your capital gains tax. Section 1. The problem: capital gains tax. Let's start with the basics. If you've made a profit in the stock market, you'll likely owe capital gains tax. 1. Short-term capital gains, STCG. If you sold assets within a year, gains are taxed at 15%. 2. Long-term capital gains, LTCG. For assets held longer than a year, gains exceeding 1 lakh rupees are taxed at 10%. So, if you've booked a profit of 10 lakh rupees, you could owe 1.25 lakh rupees as tax. But here's the good news. You can minimize this liability using tax loss harvesting. Section 2. What is tax loss harvesting? Tax loss harvesting, TLH, is a legal strategy to offset your taxable gains with your losses. Identify loss-making stocks. Look at your portfolio and find stocks with unrealized losses, called notional losses. Sell to book losses. Sell these stocks to realize the losses. For instance, if you have 1.25 lakh rupees in losses, you can use them to offset your 1.25 lakh rupees capital gains tax. Reinvest or restructure. Reinvest in the same stocks, after considering potential compliance risks, on the next day or explore better investment opportunities. Section 3. Benefits of tax loss harvesting. Why should you consider TLH? Here are some key benefits. One. Reduce immediate tax liability. Offset your taxable gains with losses. 2. Portfolio optimization. TLH gives you a chance to exit underperforming stocks and rebalance your investments. 3. Defer tax payments. Although TLH doesn't eliminate taxes, deferring them allows you to utilize the saved cash for reinvestment. 4. Carrying forward losses. If your losses exceed your gains in a financial year, you can carry forward the remaining loss for up to 8 financial years to offset future profits. For example, if you have 3 lakh rupees in losses but only 1 lakh rupees in gains, the remaining 2 lakh rupees can be used to offset gains in subsequent years. Section 4. Compliance and rules to remember. To execute TLH correctly and stay compliant, keep these points in mind. 1. Wash sale rule. In India, there's no specific wash sale rule. However, avoid buying back the same stock on the same day to ensure proper compliance. 2. Set-off rules. A. Short-term losses can offset both STCG and LTCG. B. Long-term losses can only offset LTCG. 3. Filing requirement. You must declare your capital gains and losses while filing your income tax return, ITR. 4. Always maintain proper documentation of your transactions to avoid any issues during tax assessments, Most of all the stockbroking apps have this consolidated report handy nowadays. Section 5. Addressing common concerns. Here are some common questions and their answers. 1. What if the stock price recovers after I sell at a loss? You can rebuy the stock the next day. While there is a slight risk of price fluctuation, it's generally negligible. 2. What if I no longer trust the stock or find a better opportunity? That's fine. TLH is an excellent opportunity to reassess your portfolio and reinvest in better performing or promising stocks. Section 6. Tips and examples. 1. Use TLH in January to March. The last quarter of the financial year is perfect for implementing TLH. You can evaluate your portfolio, identify loss-making stocks, and align your tax-saving strategy before the financial year ends. 2. Combine TLH with swing trades. Consider short-term trades in indices or sectors like Nifty 50, private banks, or FMCG during this period. If the trade is successful, you can hold onto it as a long-term investment. If not, use the losses for TLH. Example scenario. You book a 10 lakh rupees profit on stocks like CAMS and CDSL, leading to a tax liability of 1.25 lakh rupees. Simultaneously, you have unrealized losses of 2 lakh rupees in a few small cap stocks. You sell 1.25 lakh rupees worth of these loss-making stocks to offset your gains, effectively reducing your tax liability to zero. Tax loss harvesting is a powerful strategy to reduce your tax burden and optimize your portfolio. Remember, it's not about avoiding taxes, it's about managing them efficiently. Review your portfolio regularly and make informed decisions. If this video helped you understand TLH better, don't forget to like, share, and subscribe to Market Monkey for more such financial insights. Let me know in the comments if you have any questions or need further clarification. See you in the next one.